Hello, everyone. I am Jennifer Townsend, and I will be presenting the performance analysis of the Blue Team in the Mega Simulation. Our results show how our values, strategic decisions, and focus on sustainability have driven success even in the face of challenges. First, let's talk about sustainability. In an era where environmentally responsibility is increasingly important, the Blue Team stayed true to its values by making decisions that prioritize long-term success. Our low CO2 emissions throughout the simulation reflect our commitment to effective resource management and sustainable strategies. In fact, we consistently reduced emissions over the course of the simulation, which not only showcase our dedication to the environment, but also position us as leaders in sustainability. As eco-conscious consumers, behavior grows, low emissions becomes a competitive advantage. They improve in corporate social responsibility, attract environmentally aware investors, and appeal to customers who prioritize green initiatives. This is key strength that will continue to benefit us moving forward. Next, let's discuss a critical area of focus for the Blue Team: employee morale. High morale is critical because it's directly linked to great greater productivity, innovation, and lower turnover rates. We heavily invested in our people and the quality of our work environment, which resulted in an impressive 86% employee morale, well above the industry average of just 60%. This is a testament to our strong leadership, effective team building efforts, and focus on creating a positive workplace culture. A motivated and engaged workforce plays a pivotal role in driving both short-term performance and long-term sustainability. It's clear that our people are one of our greatest assets, and this investment will continue to pay off. Now let's turn our attention to sales revenue. While we did face challenges early on due to model specification decisions, we quickly adjusted our strategy and regained a strong market presence. The high sales revenue of 17,460 is a clear indicator of our team's operational excellence. Despite the setbacks, we were able to make necessary adjustments in marketing and product positioning, which demonstrates our agility in the marketplace and our ability to recover and grow quickly. This is a major strength in the simulation as it reflects our capability to drive revenue growth and achieve strong market performance. Let's address the area of return on capital employed. While we did experience a negative ROAS of -5%, this should be viewed within the context of our aggressive investment strategy aimed at long-term growth. We made deliberate investments to expand our market share and build a strong future, which meant higher upfront costs and short-term losses. The negative ROAS is concerning, but it is important to recognize that it is often the cost of significant reinvestment in business growth. We are already seeing improvements in ROAS, and with continued enhancements in asset utilization and more strategic investments, we're confident it will improve even further. Similar to ROAS, our average return on equity showed a negative value of 33,297. This reflects challenges with high operating costs and inefficiency in leveraging equity. However, just like the ROAS, these negative numbers are a byproduct of our heavy investments in long-term growth and market positioning. Our strategy has been to prioritize future gains, and this short-term sacrifice should not overshadow the future potential for improved returns. With a focus on improving operational efficiency, we expect ARE to improve over time as we continue to optimize our strategies. The Blue Team made a strategic decision to focus on sustainability, which led us to take a more incremental approach in developing an eco-friendly car. Our analysis of market trends, including the rising gas price index, pointed to a growing demand for eco-friendly vehicles in the long term. The data suggested that this segment was likely to see substantial growth, particularly as gas prices continue to climb. Our focus on sustainability meant we carefully considered production cost and aimed to maintain competitive pricing for the eco-friendly vehicle, positioning ourselves as both environmentally conscious and cost-effective. However, this approach posed risk. While we were committed to gradual development and cost containment, our competitors aggressively targeted the projected 15% market growth in the eco-friendly vehicle by heavily investing in innovation and marketing. Initially, this left us with a decline in sales for our eco-friendly model, as our approach seemed too cautious compared to the competition. Despite this setback, our commitment to sustainability remained firm. Data analysis revealed that while competitors had made big moves, the underlying market shift has was still in our favor due to the climbing gas and production prices. The consumer demand for eco-friendly cars was starting to increase, and our careful strategy put us in a strong position to capitalize on this shift. By adapting our approach, increasing investments in eco-friendly features, and staying true to our core principles, we were able to regain 40% of the market share in the following periods. This has not only helped us recover from the initial sales dip, but also solidified our position in a market that was becoming more attuned to environmental concerns. Ultimately, this situation demonstrates the value of data-driven decision-making in aligning our business strategy with the long-term trends. Despite early challenges, our focus on sustainability, supported by careful market analysis, allowed us to outlast competitors and capitalize on the market shift towards eco-friendly vehicles. In period 5, the blue team initially adopted a cautious approach, opting for a profitable model and developing the family model, driven by the perception that the market was declining and that customers were highly price sensitive and change sensitive. The strategy was designed to mitigate risk to avoid significant changes in the product, aiming to maintain steady sales despite a tough market. However, this strategy was not aligned with the reality of the market. Through detailed data analysis, we identified that while customer price sensitivity was a factor, there was also a growing need for innovation that our initial strategy overlooked. Specifically, the analysis showed that our competitors were successfully attracting customers by offering more innovative and appealing features, while we lost 55 orders compared to the competitors who captured 114. This gap resulted in a significant reduction in sales, a buildup of inventory, and importantly, a decline in customer loyalty. After recognizing the negative impact of our initial decisions, we conducted a deeper analysis of the competitive landscape and customer preferences. The data revealed that innovation and customer satisfaction were more critical to maintain market share than we had initially thought. Armed with this insight, we decided to realign our strategy, shifting focus to innovation and enhancing customer satisfaction. This shift in strategy had significant positive effect. Within the next period, our sales grew by 15%, and this upward trend continued into subsequent periods as we refined our product offerings and better addressed market demands. The positive risk we initially took, focused on a cautious, low innovative model, ended up being a misstep that we corrected through comprehensive data analysis. By taking the data-driven approach of realigning our strategy towards innovation and customer satisfaction, we turned a potential setback into a growth opportunity. One significant decision I made that the team adopted was a substantial investment in the low-cost model. Initially, the team was not fully convinced about prioritizing this model as it wasn't a top choice for growth. However, I explained and defended the decision by emphasizing several key points. I highlighted that the low-cost model required relatively minimal investment compared to other models, making it a financially viable option in the early stages. The risk was lower and the return on investment, though not as high as the eco-friendly model, and it could generate steady revenue. I pointed out that there were consistently seeing orders beyond our production capacity, indicating a clear market demand. I also made it clear that while the low-cost model wouldn't drive the highest revenue on its own, it could contribute consistent revenue that would be reinvested in the eco-friendly model. The eco-friendly model, with its higher revenue potential, was key to our long-term growth, but the low-cost model would sustain the company in the interim and ensure we had the funds needed for future investments. Through these points, I was able to defend the decision, and the team ultimately agreed that this model would not only support our short-term revenue, but also lay the groundwork for our long-term strategic goals. In conclusion, while we faced some challenges, the Blue Team's overall performance is a strong indicator of our commitment to growth, sustainability, and employee engagement. We've made strategic investments that set up for the future success, and we have the results to prove it, from highest sales revenue to strong employee morale and low CO2 emissions. As we move forward, our focus will be on refining our operational efficiency and capital utilization, which will only further strengthen our position. We believe the foundation we've built with a sustainable strategy and engaged workforce will continue to drive success in the long run. Thank you.